make no friends in the pits and you take no prisoners. 1 minute you're up $500,000 in soybeans, and the next, boom, your kids don't go to college and they've repossessed your Bentley. Are you with me?
The revolution starts now.
We have to pass the bill so that you can find out what is in it.
Turn those machines back on!
You are about to enter the Peter Schiff Show.
Show me the money!
If we lose freedom here, there's no place to escape to. This is the last stand on earth.
The Peter Schiff Show is on.
I don't know when they decided that they wanted to make a virtue out of selfishness.
Your money, your stories, your freedom. The Peter Schiff Show. The Peter Schiff Show.
Today's podcast is sponsored by Mint Mobile. Get your new customer offer and your new 3-month unlimited wireless plan for just $15 a month at mintmobile.com/gold. Additional taxes, fees, and restrictions apply. See Mint Mobile for details. Today's podcast is also sponsored by Kalshi. Kalshi is the first legal financial exchange in the U.S. where you can bet on any event. Bet on things like, when will the Fed cut rates? Or will TikTok be banned? Or will there be a forced sale? Go to kalshi.com/gold, and the first 500 traders will get a $20 credit.
Well, another Jobs Friday. But before I get into the tail of the tape, let me just start off today's podcast by wishing all of my Jewish listeners a Happy New Year. Yesterday was Rosh Hashanah, the Jewish New Year. We rang in 5,785 in the Hebrew calendar. We're in the 80s right now. And so Happy New Year to everybody. And let me get into the jobs report, which came out today. Now, first of all, this is the second to last jobs report that we're going to have before the election in November. But for all practical purposes, it's kind of like the last report because we get one more report before the election, but that's not going to be until the Friday. November 1st is a Friday. So we're going to get that jobs report for October on November 1st. And then on that following Tuesday is the election day. So the media will have a couple of days to kind of hype that report up. But this report is going to be what defines the media coverage over the next month. And so there's going to be a lot more at stake from this report, given that they have the whole month to hype it up and for Kamala Harris and Joe Biden to claim credit for the jobs report. Kind of gave it away a little bit, but yeah, they're going to be, using this report as evidence of how great the economy is. So given how high the stakes are for this jobs report, it means there's a lot of pressure on a highly political Labor Department to come up with a positive number. And of course, a lot of people too vote before November. They vote through the mail, absentee ballots, or people, write-in ballots. And so for a lot of voters, they're not even going to hear about the jobs report that we get November 1st because, they would have already voted. So it's going to be too late. And we already know historically that the reports that tend to be revised the most are the jobs reports. And all the revisions pretty much happen in the same direction, and that's down. They come up with a big number, gets a lot of media attention, and then a month, 2-3 months later, they quietly revise the number much lower, and they come out with a new BS number that everybody can celebrate until it gets quietly revised lower months later when they have a new BS number that everybody can celebrate. But the stakes were very high for the Democrats to come out with a positive number. I have no doubt that the number that we got, and I'm going to get to that in a minute, is going to be revised down, if not next month, because that's still going to be before the election. But after the election, in the months that follow, I would expect major reductions in the number of jobs that we were told were created, not just the report we just got for September, but even more downward revisions from prior numbers that were all basically BS. But anyway, the consensus was for 132,500 jobs created. Remember, we got a weak number the prior month. It was 142,000 jobs. And so the markets were anticipating another weak number. And in fact, if you look at the ADP number, that's the private sector number that came out on Wednesday. That was better than estimates, but it was still a low number, 143,000. The consensus forecast was 121.5 thousand. So we beat that, and we did revise the 99,000 jobs that were reported for August. That was revised up to 103, but this is still a relatively low number. Again, these are the private sector jobs. And yesterday, the Challenger monthly job cut announcement was another big number. Not quite as big as the 75,891 announced layoffs for August, but it was 72,821. I mean, it's still a big number above 70,000. That's a lot of job cuts announced in 1 month. So even though we had a relatively low ADP number, a lot of announced layoffs, we still managed to come out with a big beat on the official non-farm payroll number. We got 254,000 jobs, way above even the most optimistic of estimates. The consensus range for the jobs was 70,000 to 180. And we came out with 254. And we even revised upward, which is a surprise because the revisions almost always go in the other direction. But this month, we upwardly revised the 142,000 that was reported for August to 159,000. Now, we'll see, that might be downwardly revised eventually. My guess is that it would be. But it was upwardly revised, but also important for the politics. The unemployment rate that gets a lot of media attention, the official, the U3 rate, right, went from 4.2% down to 4.1%. So now Harris is going to be able to talk about this falling unemployment rate. But once again, the devil is in the details when it comes to the jobs report. The quality of the jobs, again, is not there. Even according to the official numbers, the biggest category that they reported was in leisure, hotels and bars, waiters and bartenders. I think that was 69,000 jobs created for bartenders and waiters. Now, the interesting thing I think about these jobs is I think a lot of these jobs are part-time jobs that went to people who need second and third jobs, because also in the numbers, we found that the number of people holding down multiple jobs hit a new all-time record high in September. And so chances are a lot of the people that are working 2 or 3 jobs, at least 1 or 2 of those jobs is waiting tables or tending bar. And in fact, we lost 7,000 manufacturing jobs. That's not as bad as the 27,000 that we lost in the prior month. That was actually a revision to a lower. They initially said minus 24,000. It was minus 27,000. Probably quite a few of the unemployed manufacturing workers are now tending bar or waiting tables. And it's probably a big step down in pay. But, it always occurs to me, too, how we're creating so many of these jobs for waiters and bartenders. I mean, is the economy that strong that everybody is eating in restaurants more often and maybe they're going out to the bars more often to just kind of drown their sorrows. But I can't believe that people are just eating in so many restaurants that we just have all these new jobs for waiters and waitresses. I mean, most likely it's the shifts where you have multiple people basically waiting the same tables in different shifts, right? People are going from job to job. People are holding down, I'm working 10 hours, I'm working 15 hours. And so I think a lot of these jobs for waiters and bartenders are not full-time jobs. There's no way we have all this demand for all these waiters and waitresses. Especially we know that a lot of these restaurant jobs have been lost in places like California where they jacked up the minimum wage and a lot of people have lost their jobs. So none of these numbers really make sense to me if you take them at face value. Of course, the other big jobs that were created were in healthcare services. A lot of these jobs, of course, are paid for with government money, which is a problem. I mean, the private sector is not producing the jobs. And I've gone over that on prior podcasts. There's a huge difference between a private sector job and a government job, right? The private sector jobs are not the responsibility of the taxpayer. The private sector jobs are created by the profitability of the employer. And how is that profit derived? It's because those workers are helping to provide goods and services that consumers want, that they value and desire, and are willing to voluntarily pay for. Right? So we need these jobs. We want these jobs. Private sector jobs are productive, goods producing, service providing jobs that make our lives better, that we want, and that we're willing to exchange the dollars that we earn for the goods and services that these workers are helping to provide. So that's all a good thing. But government jobs are a completely different animal. They're not paid for by the profits of the employer because the employer has no profits. The employer is the government. Where does the government get the money to pay its workers? From us, from the taxpayers. Whether we want the services or not, whether we use the services or not, we have to pay for them. And the money comes right out of our pay if it's wage taxes, or it's tacked on to the price of all goods that we buy if it's a sales tax. But of course, a lot of the jobs that the federal government creates, they don't raise our taxes to pay for them. They just run larger deficits to cover the costs. And when they run those larger deficits, well, we end up with more inflation. So we pay for these jobs through higher prices. But of course, they're also not productive. They're not adding to the goods and services that we all want to consume. In fact, all of these government workers are competing with us with our own money, because you have all these government workers that are now being paid, but who have not been productive. But they want to go spend their paychecks just like everybody else. They want to buy all the same goods and services that they don't help produce, but that they want to consume. So now they take this money that they got for producing nothing, and they go and buy the goods and services that other people in the private sector produce. So now you just have more demand for that supply, and prices are going to go up. So the fact that we have all these government jobs being created is not good news, not for the public, but the media doesn't differentiate. As far as they're concerned, a job's a job. As long as there's a job created, well, they're going to credit the Biden-Harris administration for that job, and they're going to go around the country bragging about all these new jobs that have been created. But again, a lot of the people who have these jobs don't want these jobs. They would prefer not to need these jobs. But unfortunately, inflation has been so rampant over the last 3-4 years that people can't get by on one paycheck. And that's why they need a second or third paycheck. But I want to actually get into something that I learned later today about this jobs report and just how bad it actually was, and just how fraudulent it really was when you really dig down into the weeds to see exactly what happened with government jobs in September. So I'm going to talk about that on the other side of this commercial, so don't go away.
I love a great deal as much as the next guy, but it has to be easy. No hoops, no BS. So when Mint Mobile said it was easy to get wireless for $15 a month with the purchase of a 3-month plan, I called them on it. Turns out it really is that easy to get wireless for $15 a month. It's time to switch to Mint Mobile today and enjoy unlimited talk, text, and data for just $15 a month. In fact, when it was time to get my son Preston his own phone, Mint Mobile was the perfect choice. Forget about the steep monthly fees and overages that you get with your current wireless plan and make the switch to Mint Mobile's premium wireless plans, starting at just $15 a month. Choose any Mint Mobile plan, which includes high-speed data with unlimited talk and text on the nation's largest 5G network. You can even keep your current phone and number when you switch and bring over all your existing contracts. Ditch overpriced wireless with Mint Mobile's limited time deal and get 3 months of premium wireless service for $15 a month. To get this new customer offer and your new 3-month unlimited wireless plan for just $15 a month, go to mintmobile.com/gold. That's mintmobile.com/gold. Cut your wireless bill to $15 a month at mintmobile.com/gold. $45 upfront payment required, equivalent to $15 a month. New customers on the first 3-month plan only. Speed slower above 40 gigabytes on unlimited plans. Additional taxes, fees, and restrictions apply. See Mint Mobile for details.
All right, so I'm talking about this BS jobs report for September that came out stronger than expected. I'm going to get into the market reaction in a moment. Let me just finish talking about the report itself. But when I first heard the number, of course, I know it's just a bunch of BS, but I didn't realize how much BS was in there until I read the article on Zero Hedge. They did a really good job of getting into the household survey numbers, which also is the other report that comes out and helps determine the unemployment rate that is part of the official rate. And according to the household survey, there were 785,000 government jobs created in September. Now, that is the second most government jobs in any single month in history. That is a huge outlier. And the only other time there was a month where more government jobs were created than that was, I think it was June of 2020, right, during COVID. We had just had a bunch of jobs that were furloughed, and then they came back. And so the numbers were all over the place. So that COVID month was a total outlier. So if you just don't even count that month, this was the most ever, right? I mean, a huge hiring spree by the government, according to the household survey. Now, of course, is it a coincidence that, we're going into an election and the government wants the jobs numbers to look good, and so they go on a hiring spree and start hiring a bunch of workers? Again, doesn't matter. See, when the private sector is hiring workers too, it's it's somewhat reflective of the outlook of the employers on the economy, right? If you're an employer and you have a positive outlook, hey, the economy's picking up, my business is going to get better, you want to get out in front of that. You're going to hire more people, or maybe you're seeing a pickup in demand for your products or for your services, and so you go out and hire more people. So the fact that the private sector is hiring, you can say, oh, that's a good sign, right? There's confidence there. The economy is getting better, but you can't make any of those conclusions based on government hiring because they don't give a damn. They don't have a profit and loss. They're not motivated by that. They can easily be motivated by politics. Just go out and hire people, right? Borrow more money, put more bodies on the payroll so we can pad the statistics. Because I don't think it's a coincidence that we have such a out of the ordinary, massive increase in government hiring. In fact, according to that same household survey, only 133,000 private sector jobs were created in September. That means that of all the jobs that the household survey is tracking, 86% came from the government. Now, does that sound like a strong economy when 86% of all the jobs were created by the government, which means they're being paid for by taxpayers, right? We're on the hook now to pay the salaries for 86% of the jobs that were created. Again, when the private sector creates a job, I'm not on the hook for anything. But when the government creates a job, we're the employer. We're paying the salaries of those workers, either through taxes or through inflation. But it actually gets even worse when you back out the seasonal adjustments. Now, there are a lot of seasonal adjustments in September. It's the end of summer, so, some summer jobs come to an end. But other jobs like teachers, they've been on vacation all summer. They go back to work. So there's a lot of seasonality in September. And so the government makes those adjustments. But if you back out the adjustments and just look at the actual jobs that were supposedly created and destroyed, it's even worse. Because there, if you don't adjust it, according to the government, 918,000 government jobs were created in September. That is a record. There's never been a non-seasonally adjusted month, according to the Zero Hedge. There's never been a month in history where that many government jobs have conveniently been created in a single month. So I don't know if it's actually true that the government actually hired all these people, or if this is just, something that was concocted out of thin air by the statisticians and is just going to be conveniently, revised lower after the election. But look at what happened to the private sector. According to the non-seasonally adjusted numbers, the private sector actually lost 485,000 jobs in the month of September. So the only reason we actually had jobs created was because of the seasonal adjustments that made the jobs created. But the actual number was a loss. And again, so what that means is that all of the jobs, 100% of whatever jobs were created during the month of September were created by the government, either the state and local government or the federal government. The private sector actually lost jobs. And again, the problem is it's the private sector jobs that pay the salaries of the government workers, because it's the private sector that gets taxed. Now, of course, government workers, they claim they pay taxes, right? Everybody who works for the government says they pay taxes just like everybody else, but they don't actually pay taxes. Yes, I know. Let's say you're a government worker, right? You work for the federal government, and there's federal income tax that's withheld from your pay. You think you're paying taxes. You're not paying anything, because you're not giving the government anything that they didn't already have. See, let's say the government is paying you, or a teacher or whatever, or a government worker, $100,000, and then they take $25,000 back in taxes, right? The worker thinks, well, I earned $100,000 and I paid $25,000 in taxes. No, you earned $75,000 and paid no taxes, because the government had the money to begin with. So what's the difference if the government gives you $100,000 and takes $25,000 back, or just gives you $75,000? There's no difference for the government. The government started out with the money. It's just taking some of it back. It's creating the illusion that government workers are just like anybody else and they're paying taxes. They're not. If you're a government worker and you got $100,000 from the government and then you gave $25,000 back to the government, you still got $75,000 from the government. You didn't pay anything to the government. The government paid you $75,000. It's a totally different story if I earn $100,000 from a private employer and then I take $25,000 of that money that I earned and send it to the government, because the government never had that money. So that's actual new money that's going to the government from me, the worker. The government workers don't give the government anything. The government just takes back a little of what they gave them. So, but they do this. The only reason they go through the motion, right? Why have the extra paperwork? Why not just say, look, we're going to save money. We're going to save time. If you got a job for the federal government, you don't have to pay any federal taxes on your wages. We're just going to pay you less. And so the money doesn't have to make the round trip. The reason they don't do that is they don't want people to realize that these government workers aren't paying taxes. So they want to make it look like they're just like everybody else. And all these government employees, well, yeah, they're paying taxes. They're not taxpayers. They are tax takers. And where does the money come from? Again, to pay the salaries of these government workers. It comes from the people in the private sector who are actually giving the government money that it doesn't already have. And it uses that money to pay the workers. So that's what's a big problem when you have a real economy where the number of actual tax-paying jobs is destroyed. And all we're doing is creating more tax-taking jobs. And so what does that mean? That means bigger deficits, and that means higher inflation. That's what's coming. In fact, according to Zero Hedge, but for the surge in government employment in the month of September, if you just back that out, right, and just maybe it was just a normal month, according to Zero Hedge, instead of the unemployment rate going from 4.2 to 4.1 the month before the election, it would have spiked all the way up to 4.5%. Now, that is a headline that the Harris administration does not want to run on. And so conveniently, we've had the biggest government hiring boom in history that was able to bring the official unemployment rate to 4.1. Now, we're actually better off if they made it all up. I mean, if the government actually hired all these workers, it's actually worse than the government just making them up, because we don't actually have to pay for the made up workers. So if this is all pure BS, if these jobs don't actually exist, but the Labor Department is just pretending they exist, right, just so they can goose the numbers, then at least we don't have the bigger deficits and the higher inflation that is going to be the result of all these new government workers. But either way, right, it's a bad thing. But if they're actually there, it's even worse. There was one more news item, too, that came out this week. I guess that was positive for the labor market. And that was they settled this strike at the ports, which had been going on for, I think, 2 or 3 days. The longshoremen's union came to an agreement on wages. And the deal is for a 62% wage hike over 6 years. So 10% a year increase in pay for, like, I don't know, 45,000 longshoremen who are working in these ports. Now, they're still negotiating over automation. You see, not only do the longshoremen want to dramatically increase the cost of employing them, but they also want to make it harder or impossible for the employers to then replace them through automation, right? Because the more expensive you make workers, the cheaper you make automation. And so they want to jack up their wages, and then they want to prevent their employers from firing them because they're too expensive. So the second part, they're still negotiating, but the wages they settle. But the interesting thing is you've got the Fed claiming that, okay, we got no more inflation. It's 2% as far as we're concerned. These workers are getting 10% pay hikes every year for the next 6 years. Does that sound like an environment where you have a 2% inflation when these dock workers are getting 10% raises every single year for 6 years in a row? Doesn't sound like a low inflation environment to me. Not that these wage hikes themselves are going to cause the higher inflation. They're simply symptomatic of an economy that already has very high inflation. In fact, none of the data that's come out, and I'll get to some of that after this break, but none of the economic data that came out this week suggests in any way, shape, or form that inflation is going back down to 2%. All the data says inflation is headed in the other direction. I'm going to get into that data on the other side of this commercial, so don't go away. We'll be right back.
There's finally a way to trade directly on events that directly relate to companies, such as what inflation will be, or interest rates, or will ChatGPT 5 be released this year, or how many cars Tesla will deliver this quarter. Kalshi, which was founded by 2 MIT engineers, is the first legal financial exchange in the U.S. where you can bet on any event, It's basically like the New York Stock Exchange or the NASDAQ, but instead of day trading stocks, you're betting on things that you actually care or maybe even know more about. The exchange has hundreds of thousands of users and has already seen more than $500 million of trading. Kalshi has a ton of company-related markets where you can make money by betting on the things that impact companies most. Let's say you believe the Fed will cut rates 5 times this year. It's currently priced at a 43% probability. You can buy shares of 5 rate cuts at 43% or 43 cents. The price changes based on what the market thinks the odds of that event are. Let's say you want to buy 100 shares and you pay 43 cents a share. Times 100, that's 43 bucks. If the Fed cuts rate 5 times, you win 100. If not, you lose it all. You can always sell your shares before the results come in. Like if the price goes to 80%, you may want to sell your shares for 80, booking a $37 profit rather than holding to the end and risking losing it all. You can also pick other numbers of rate cuts. For example, you can bet that 3 or more will happen this year. For me, I look at Kalshi as a fun way to gamble while potentially hedging some of your actual stock positions. Kalshi has many company-related markets to trade on. You can sign up using my link at kalshi.com/gold. And the first 500 traders will get a free $20 credit. That's kalshi.com, KALSHI.com/gold.
Okay, well, before I actually get into the market reaction to the non-farm payroll numbers, the stronger than expected jobs report, I want to talk a little bit more about what I was just discussing before the break on automation and employers substituting labor for capital, which is what the longshoremen are trying to prevent their employers from doing. It's also, something that's going on now in states like California, but also other states where the minimum wage has gotten so high that employers are now looking to replace their overpriced workers with more efficient machines, automation, robotics, now artificial intelligence. There's always a cost-benefit analysis that a businessman does whenever they're replacing workers with machines, because in order to do that, there is a big upfront cost, right? You got to lay out the money to make the investments in the capital equipment that will replace the workers. And then, of course, you have to depreciate that equipment, but you figure out what the cost is of implementing your labor-saving devices. And then you compare that to the benefit you get by eliminating the workers. Now, the more expensive those workers are, the bigger the benefit to get rid of them. And so when the government comes in and says, oh, we're going to increase the minimum wage of unskilled workers to $15 an hour, $20 an hour, $25 an hour, they greatly skew that cost-benefit analysis in favor of layoffs and automation. I mean, maybe if I can pay the workers $10 an hour, it doesn't make any sense. It's not a smart move to invest the money in automation. I'm better off just paying my workers. But now if I have to pay those same workers $20 an hour, they're no more productive. I just have to pay them twice as much because the government passed some law. Well, now it may be cheaper to fire them all and replace them with machines, especially since the cost of the automation tends to go down. There's always advancements. Things get more efficient. They get cheaper. So the cost of the machines is going down as the cost of the labor is going up. And so that is driving the move. But of course, you also have a lot of other issues that the government creates that makes it a much better proposition to fire your workers and replace them with machines, because your machines can't sue you for wrongful termination, for sexual harassment, for discrimination, right? There's all sorts of ways that a human being can sue you as an employer. And that just adds to the cost of employing people. And it adds a big uncertainty. It adds to potential legal liability. And it's not just, when you hire somebody, it's not just that you have to worry about maybe I say something, I'm the boss, and I say something that offends one of my employees and I get sued. No, it's not just that. I get sued if one employee offends another employee, even if I got nothing to do with it, right? I'm the one that gets sued because I'm the employer of the employee who offended the other employee. I'm just the innocent guy who happened to create these jobs, and no good deed goes unpunished. I'm the one that gets sued because I'm the employer. So there's all kinds of risks you have when you employ people. And you can mitigate those risks by employing fewer people. And so that's what automation allows you to do. And of course, now that we're getting the artificial intelligence, a lot more jobs that government regulation is increasingly making more expensive to employers. You're going to have even more of a motivation to replace those workers with machines. And so that's what's going on. And they know that at the Longshoremen's Union. They realize that, this 62% pay hike is a big number. And that's going to mean that a lot of the analysis that these ports are doing on should we invest in automation and fire all these workers, now maybe it pencils out. So now they're trying to prevent the employers from doing what they normally would do based on a wage scale that is unreasonably high. Anyway, so let me get to the market reaction to the numbers. And of course, for a while, it was bad news is good news. Well, now, good news is good news as far as the market is concerned, because the market is no longer worried about the Fed not cutting rates. The Fed is going to cut rates. I think the market understands this. The rate cuts are coming regardless of these job numbers. So we don't need bad jobs numbers to keep the rate cuts coming. And so I think the markets understand that the Fed is really, on autopilot, despite the fact that it claims it's data dependent. I think the markets are seeing through this, and they know that we're going to get more cuts. And also they probably realize that, they know that these numbers are probably going to get revised, and they probably don't, put as much weight into this so-called booming economy. And again, it's not really booming. It's not a lot of jobs that were created anyway, even superficially. But the markets rallied. And in fact, all the major stock markets had a positive day. They were going to have a negative week. This was going to be the first week of the fourth quarter. And the indexes were all in negative territory until today. So today, everything got bailed out. The Dow was up about 350 points. And that was good for about a 0.5% rise on the week. S&P not up quite as much and eked out a 0.2% gain on the week. NASDAQ up 0.3%. Again, all that today. I think the NASDAQ was up 1.2% today. So prior to today, it was negative. But, this report caused the market to rally. The only major index that was down was the Russell 2000. That was down 0.2. But what was really interesting to me was a few of the other markets. Oil rose 9.5%, almost 10% on the week. And I was talking on this podcast about how cheap oil was and how I didn't expect it to stay cheap. And I pointed out in terms of gold, it was basically a record low. And so oil prices ended up about $74.50. They closed last week about $68. So I think we've broken out of that downtrend. I mean, part of that had to do with hostilities with Israel and Iran and the potential for an escalation there. But that may have just been the catalyst to break the downtrend. But now that little trend is broken, to me, it looks like oil prices are headed higher from here, not lower. And again, that is symptomatic of inflation, because the big driver for the drop in headline CPI was the big drop in oil prices. And as I've said, as that reverses, those numbers are going to feed in to that headline number. But again, the Fed's kind of on autopilot. But what's happening in oil is indication that the Fed was wrong. I mean, why did they do 50 basis point cut. Why'd they cut at all? Oil prices are rising. Hey, the job market, according to what the government says in Wall Street, job market is strong. Unemployment is falling. Jobs are being created. There were some other numbers that came out this week in the service sector that were stronger than expected. All the manufacturing numbers were weak. In fact, I have some of those. The factory orders were minus 0.2 in August. They were supposed to rise by 0.2. So that was a weak number. What else we got? I had a bunch of these weak numbers. Construction spending was down again 0.1. It was down 0.5 in the prior month, even with the reduction in mortgage rates. We still saw that. PMI manufacturing numbers for September, 47.3, below the 47.9 from the prior month. A little bit above estimates, but still down. It's anything below 50 is contraction. I mean, this manufacturing recession has been weak. The ISM manufacturing number for September, 47.2. That was below the 47.6 estimate. Same low number that we got in August, 47.2. So all of these manufacturing numbers, Dallas Fed manufacturing minus 9, was minus 9.7. The prior month production index, which was plus 1.6, sank to minus 3.2. So no one really cares. I mean, Joe Biden or that Kamala, is bragging about all the manufacturing jobs, and now Kamala Harris wants to take credit for this manufacturing renaissance that doesn't exist. Even the government-owned numbers show that we're in a manufacturing recession. Chicago PMI, another September number, 46.6, a horrible number. Yeah, it was slightly less horrible than the 46.1 that we got the prior month, but it's still way below 50. But the only number that really came out strong was the ISM service index, and that actually gave a boost to the dollar, came in at 54.9, well above the 51.5 from the prior month. So that was a lone kind of outlier. But again, if the service sector, because then that's 70% of the economy, right? Manufacturing, unfortunately, is a tiny slice of this economy. That's part of the problem. The much larger slice is services. And there we saw the big jump. So all that would suggest that the Fed's rate cut was a mistake. But nobody cares that it was a mistake. Everybody is just glad that the Fed is cutting rates. But not only did we see the move in the oil market, look at the bond market. And this is a move that I had predicted. In fact, last week, I said that I thought that in this quarter, before the end of the year, the yield on the 10-year would be back above 4%. And we're almost there. We're at 3.97. We were like 3.7 a week ago. So 3.97, we should be well over 4%, headed up to 4.5, shortly, probably before the end of the year. I don't know that the Fed will let us get back to 5%. I thought that rising long-term bond yields would ultimately be the catalyst for the return to QE, and I still stand by that call. The yield on the 30-year U.S. Treasury is now at 4.25%. And, we've got the yield curve steepening now. On the 2-year, you're at, the 5-year is 3.8. So you're going 3.8 to 3.97 to 4.25. You still have a little bit of an inversion because the 3-month is 4.61. That's still the high end of the curve. And the 6-month is 4.44. But I know that the long end is going to get back above the short end. And again, it may even do it this year. We get another rate cut this year and long-term rates continue to rise. That's going to normalize the curve. But again, the longer-term rates, that's what has more of an impact on the consumer. That's what's going to determine mortgage rates. That's what's going to determine other borrowing costs that directly affect the consumer. And these rates are going in the wrong direction. And the only way the Fed is going to bring them down, at least temporarily, is by a return to quantitative easing. But before they can return to quantitative easing, they got to stop doing quantitative tightening, which they are continuing to do. In fact, the balance sheet is getting very close now to $7 trillion. It's not below it yet, but it's as low as it's been since they started shrinking it. Now, the dollar index had a big move on the week. It was up about 2 full percent. That's the strongest week I've seen. The dollar gained again today on the jobs numbers. It gained on that ISM number. It's been strengthening all week, particularly against the Japanese yen, but also against the euro, the Swiss franc. The dollar index closed the week at 102.5. We were very close to breaking 100. We were about at 100.2 earlier in the week, and we had this rally in the dollar index. Now, I don't think that the rally is going to last. I think that it's going to roll over and head back down. But that was more significant move. And what that is basically suggesting is now the way the currency traders looking at it, they don't expect the Fed to be as aggressive with its rate cuts. That's probably what currency traders are betting based on these numbers. I think that they're wrong. The Fed is still going to cut rates, but what's important is that real rates are going to fall regardless of what the Fed does, because inflation is going to be on the rise and the Fed is going to completely ignore it. In fact, most people that I listen to, if you just turn on the financial news, they've all bought the idea that inflation is over, that inflation is no longer a threat, that the Fed has won. And the only real evidence that they have to point to is the Fed. Well, the Fed says that it's not a concern. The Fed, the Fed claims that it's going back down to 2%. Well, who cares what they claim? They don't have a good track record anyway, but they could just as easily be lying. In fact, they've admitted that they believe that the most important aspect of inflation is consumer expectations, right? If people expect inflation, they'll get inflation, as if expectations are the driver. But if that's what you actually believe, then what do you want to do to fight inflation? Well, you want to lie to the public and tell them there's nothing to worry about. Hey, there's no inflation. We got it licked. And if the public believes it, well, then maybe there'll be no inflation. So if you actually believe that expectations are why you have inflation and you're a central banker, what do you want to do? You want to try to clamp down on those expectations. Well, how do you get the public not to worry about inflation? Well, tell them not to worry. Tell them that you got it licked, right? That inflation is going back down to 2%, and try to influence those expectations. I mean, the last thing that you would do if you're a central banker and you really think that expectations are what drives inflation, why would you come out and say, yeah, we expect a lot of inflation in the future, right? Because that's going to create a self-fulfilling prophecy. People are going to say, oh my God, the Fed is telling us there's going to be a lot of inflation. I better go out there and spend a bunch of money. I better demand a pay hike. I better raise prices, right? They are worried that they're going to impact the way people behave based on what they say. So to try to point to what the Fed says as a basis for believing anything about inflation coming down is ridiculous. All the anecdotal evidence would suggest that inflation is bottomed and it's headed back up. But nobody wants to admit that. Now, gold, on the other hand, despite the 2% rise in the dollar, despite today's better than expected jobs report, gold was still positive on the week. In fact, it was only down about $5 today. Right? Normally, when you get a day, I'm talking about last year or two, when you get a day where the jobs number is better than expected, gold gets hammered. $30, $40, $50, which isn't even as big a percentage move when you're talking about $2,600 gold. But gold barely went down. I mean, they got it down maybe $20 or so on the absolute low, but it was there just very briefly. Then it was down maybe $12, $14, and it, clawed its way back, but it was barely down. And it closed at 2,650. So a strong price, another small up move in the price of gold. Silver, on the other hand, not only didn't get killed today, which it has been, right? When we've gotten better than expected jobs numbers, they crush silver, 50 cents, 75 cents, $1. Look back at some of these other numbers that, that came out stronger than expected. Silver got killed. Silver was up today. Silver rose 3.2% on the week, and it closed the week above $32.12. This is only the second time we've had a close above 32 over the past 11 years. So silver as I've been saying, is looking very strong. And I think we're going to have a major, move up in silver and gold. Again, could start any day. It could start Monday. Just don't, press your luck if you haven't bought your gold or your silver yet, especially your silver. Call up Shift Gold and get some gold, get some silver, get it over the weekend. Go to our shopping cart, load it up, check out. We're going to be introducing a lot more payment methods soon. We're in the process. Our application is being reviewed right now. When you go to shiftgold.com, you can only pay, through a bank wire. But we're going to be allowing payment through ACH and through credit and debit cards. So that's coming. We just have to get the approvals. We have to pass all the KYC and AML from the companies that do that. And they make it difficult for people that sell gold and silver. That we're considered high risk, right? Because people are going to be using their gold and silver to money launder or evade taxes. In fact, look what's going on over in Israel. I think I didn't even mention this, but I read stories that Israel's trying to clamp down on tax evasion or money laundering and talking about outlawing the ownership of gold and silver in Israel. That would be a disaster if that were to happen. I mean, that would be one of the consequences of this war that's going on, where the government inflicts unnecessary damage, and the terrorists win because the government uses the threat of terror to further diminish individual rights. They talk about, terrorism or money laundering. So that hopefully that doesn't happen. But before it does happen, I'm sure people in Israel are going to be loaded up on more gold and silver before the government says that you can't buy it. Whatever the government tells you not to do, that's exactly what you need to be doing. It's what they encourage you to do that you need to reconsider. Anyway, looking at the gold stocks, typically they're following the same pattern. Even though gold was up, almost 0.5%, silver was up 3.2%. Both the GDX and the GDXJ finished the week down by about 1%, right? Eventually, these gold and silver mining stocks have got to stop going down just because the price of gold goes down, or in this case, only goes up by a little bit. If gold were to drop $500 an ounce, these gold and silver mining stocks would still be cheap. That's what investors still don't understand. See, right now, these stocks almost always trade as a proxy for the price of gold. People forget that they're actual businesses. And the value of these businesses is not really affected that much on the margin by a $10, $20, $30, $50 swing in the price of gold. Doesn't really matter. If you look at these stocks as a business and you look at where the price of gold is and where it's likely to be in a year, in 3 years, in 5 years, and look at how cheap these stocks are, it doesn't matter if the price of gold is $2,650 or $2,600 or $2,500 or $2,400. It doesn't matter. What matters is that the price is high enough for these big companies to make a ton of money, right? They're going to generate a lot of cash. They're going to increase their dividends. They're going to be buying back shares. The stock prices have to go up. But right now, nobody is even thinking about these companies as actual businesses. They just, the price of gold is up. Oh, let's buy gold stocks. Oh, the price of gold is down. I better get out of my gold stocks. And so what happens is gold goes up, gold stocks goes up. Gold goes down, gold stocks get crushed. Then gold comes back up and the gold stocks go up, but they don't quite make it to where they were before they got crushed. So then gold keeps going up. Eventually the gold stocks catch up, make a new high. Then of course gold corrects and they get killed again, right? Nothing goes up in a straight line. Gold could go to 3,000 by the end of the year. That doesn't mean it's going to get there without any down days or without any down weeks. Of course, gold's going to have down days. It's going to have down weeks. This should be irrelevant to these gold stocks because they have so much they have to go up just to catch up to where they should already be, that all this daily trading, it's all a bunch of irrelevant noise. At some point, it won't matter. But wow, it does matter. Take advantage of the gifts that the market keeps on giving by buying these gold stocks. We own the gold stocks in all of our strategies, our value strategy, our dividend pair strategy, but of course, in our gold strategy, in our gold fund, that's all we own. So that gold fund, the Euro Pacific Gold Fund, is still an incredible buy right here. You can learn more about my funds at europac.com, EUROPAC.com. There is a page there on the website that goes into all the funds. I mean, once again, the big mover on the week was the Emerging Market Fund. Let me see what it did today. Up another 1%. It looks like. I don't know. I think that, yeah. Or is that yes? I mean, I think it's up something like 10% in the last week and a half. So we've really started to see a big move in these emerging markets, again, led by China. China's had some huge moves coming off a very, very depressed base. There's been so much negativity on the Chinese market in the mainstream financial media throughout the year that these stocks have been really beaten down, taken out, shot, left for dead. The government stimulus, this is not the reason to buy these stocks, but it may have been the catalyst to turn them. Because, again, they were looking for a catalyst because they weren't going to stay this cheap forever. And now something has happened to wake up the market and reverse the flows. And so that is, I think, and I've been saying all year, that was the sleeper fund. It was the emerging markets. And so I think that's what people should be looking at, too. So it's emerging markets, it's commodities, it's precious metals. Those are the sectors that I think are going to do really well in this quarter, but more particularly in 2025. And I think that is regardless of the outcome of this election. Oh, before I forget to mention Bitcoin, also interestingly enough on Bitcoin was down. The Bitcoin ETFs were down about 2.5% on the week, despite NASDAQ going up, despite gold going up. Bitcoin went down. So I guess there you go. It was uncorrelated. Almost everything went up. Bitcoin went down. Interestingly, Bitcoin traded just below 60,000 a couple of times intraday, but so far it's having some support at 60,000 as I'm recording this podcast now, Friday after the close. Let me see where it's trading. I think it was last I looked, it was back above 62,000. Let me see. 62,250. But when Bitcoin was below 60,000 and gold was about 2650, 2660, Bitcoin was actually more than 40% below its record high set in November of 2021, priced in gold. That is a huge bear market. They're promoting Bitcoin as a superior alternative to gold. Don't buy gold. In fact, drop your gold, dump your gold, and buy your Bitcoin. Well, if you did that at the peak of Bitcoin in 2021, you have 40% less money than if you just held on to your gold, right? Your old-fashioned yellow rock, the way they describe it, has done substantially better than Bitcoin. Now, yes, granted, that's since its all-time high, but how else do you measure a bear market but from the all-time high, right? If you want to know how bad a bad market is, right, how big it is, how much is lost, you have to find the high, and then you got to compare it to where you are right now. A lot of people in Bitcoin, accuse me of cherry picking. Well, it's not cherry picking when I'm picking the top of the market. I'm trying to, talk about how much we've declined from the peak. That's what defines the bear market. And so Bitcoin peaked almost 3 years ago. And from that peak, it's down 40%. Now, if that's not a bear market, I don't know what is. Now, the question is the bear market over? I don't think so. I've seen nothing to indicate that Bitcoin is going to stop its decline relative to gold. In fact, if Bitcoin was going to go up relative to gold, it would have already done it, right? All these new Bitcoin ETFs that were created this year, we've had outflows from gold ETFs and huge inflows into Bitcoin ETFs. Yet despite that, despite the fact that the American public is buying all this Bitcoin and selling gold, gold is kicking Bitcoin's butt since March of this year, right? Why is that? Bitcoin should have outperformed gold. The fact that it didn't is a good indication that the bubble has popped and the air is coming out. And so this bear market, I think, is just getting started. Anyway, that's it for today's podcast. Hope everybody enjoys this weekend. Again, don't forget to give us the thumbs up, put some comments on the videos. And also, if you haven't gotten around to signing up for our free newsletter at shiftsovereign.com, make sure and do that. We're putting out a lot of really good content, generally every other day at Shift Sovereign. So make sure you're getting my emails in your inbox, and that's shiftsovereign.com. Bye for now, everybody.